Thank you very much. Thank you for the introduction, and thank you to NCFA and Fintech and Funding for putting on this event, but also the month-long conference. Certainly interesting time for a conference, and I'm sure you've had your challenges, but it's been great so far. And so I'm here today. I'm excited to present my company, Corl Financial Technologies, and so I will share my screen so you can all see. Here. Great. So yeah, as I mentioned, my name's Ben Ames. I'm Chief Investment Officer at Corl Financial Technologies, and our thesis is the digital economy, essentially, and providing products and services that complement and can promote the growth of this large part of our current economy. And what do I mean by that? Well, it's our mission to reduce unwarranted bias in the financing industry. We want to provide technology and financial products that leverage data and technology rather than more manual processes in order to fulfill financing and ensure that companies have access to capital as needed. When I say the digital economy, I mean companies that derive a majority of their revenues from online sources. So today it is already quite a large market. It's about 30% of the S&P 500. And probably the most impressive statistic is that the entire value has been generated in the last 20 years or so since the launch of the internet. And to give you a little bit more context here, it's currently just around 7% of the entire US GDP, but certainly has quite an opportunity to grow and take market share as we start shifting to more online means, including online conferences like this one. So certainly quite a bit of opportunity out there. But what's the problem today? So the problem today really is that the financing process is quite antiquated. It's rather manual and certainly time intensive. It doesn't rely on a lot of data for decision making, which then promotes unknowing biases in the underwriting processes. The financing products today we know of coming from either equity or safe instruments, as well as other non-dilutive instruments like venture debt, certainly ones that could have opportunity for some alternative products to go at this market. What's our solution? So our solution is a financing process that is modern and automated. It relies on data to make decisioning, and which then will reduce biases and define your investment thesis. And we believe the financing instrument of tomorrow to be what we call a revenue sharing financing instrument. Currently, we have a number of products that are in market, everything from onboarding of a company to measurement and the origination practices that for underwriting investments, as well as servicing, monitoring, and management of your deals. These products are live and in market. We have white labeled approaches with a number of companies, as well as more custom things, and including the Government of Canada. Our experience, so as a company comes to the Corl website, they can apply for funding through an online application. We'll onboard companies in this fashion, where they provide certain information about the business and themselves, and then we collect data through our online APIs. So we aggregate and analyze over 10,000 data points attributed to a business, the owners, as well as the industry and the market. And then we use this data to provide insights and analytics into our investment processes. The great thing about the APIs is that the data is updated on a monthly basis, so you can monitor and track your investments in real time. Now, who are we? We are finance experts with a lot of experience in this space, designing credit models, including IFRS 9 and other related projects. We've worked with a number of Schedule I banks, loan companies, credit unions, Schedule II banks, and other loan companies in the space. So we have quite a bit of experience in credit modeling space and designing of these products. Now, our first financing product, and by financing product I mean Corl providing investments on book, is what we're calling revenue sharing financing. We'll provide investments up to $300,000, and then in exchange for funding, business will pay Corl a percentage of their monthly gross revenue, which is known as a royalty rate in perpetuity. This business has the option to buy out the contract at any time by paying a contract buyout rate, and then that payment would end the percentage of revenue that we collect and end our financing arrangement. We've designed an algorithm, a credit score, to do the majority of our underwriting. And so as companies come in and provide data from a number of different sources here, we use that data to determine a credit score. If a company hits over a 750, then we'll move forward with kind of final due diligence. But at that point, we basically have an idea of if we can do the investment or not, and if so, at what terms. So where we're at today, we a top 25 leader in lending in Canada, as awarded by the CLA, as well as a top 10 innovative lender by the CLA as well. We're top 5 hottest startups in 2017, as well as best tech startup in 2018 TIMI Awards. And so also have quite a large community across our different social channels and continuing to grow on that side. And so that's cool. I look forward to questions from the judges here, and we will continue to be executing on our thesis of financing the digital economy.
Great stuff. I'll jump in first this time, if that's okay with you, Elizabeth.
Oui.
So I'm gathering from the pitch or the demo that there was no, you don't currently have any customers, and I'm wondering how many businesses have you run through your model to give a credit score to, and how confident are you with those credit scores, if you will?
Yeah, for sure. I mean, we do have customers today, so we do have customers both on the white label side, also kind of custom underwriting solutions. But we also do have kind of a fund one that we are investing out of, and so we've issued some revenue sharing investments as well.
You should definitely put that on your traction slide. That's way better traction than what you have on your current traction slide.
Sure. Yeah. Sorry, I thought I had made mention of that, but definitely we'll highlight it better in the next one. But then I guess in regards to your second point with the credit scoring, we've had 2,500 companies go through the online application. They've based on that data, as well as data that we've pulled from other public sources. We use that to determine our credit scoring. We did run a back test based on companies that hit above the 750, so with no further due diligence or final due diligence, but just purely on the credit modeling, and we achieved a return that was above market in venture capital space. And had very low default rates on that side. So for purely from just a quantitative underwriting standpoint, the credit model has checked out.
Good stuff.
I'll jump in. Great presentation. Really interesting business model. For me, I guess it was a question where I'd like to see maybe either as part of the demo or as part of the benefits positioned. So if I'm a company in market, I have revenue. If I'm over 750, which is pretty good credit score, my traditional financing arm would be with one of my banking partners. And so maybe it would be showing just a really simple kind of graph, what that would look like. You said you've kind of back tested it. So going back in terms of a revenue share, as a business, I want to get, the most cost effective debt. As the one providing the money, I want to get the best return. And I think if I understood correctly, so yeah, I think in your demo or in your pitch, you need to be able to position both of those as a statement, why it's in the best interest of the business that's looking for funding and why it's in the best interest of somebody who has money to put up. And I think that was the only part I didn't quite understand is the money that's funding these loans. Are you hooking investors to companies? Are you a conduit? Are you a clearinghouse? Are you a vetter? Like it just wasn't clear if there's an opportunity for the investors to participate. So it's a two-sided equation. So I'll let you answer that question. Before I jump to the next one.
Yeah, no problem. So currently we've been deploying capital from an internal raise that we did. So we don't have an instrument just yet for investors to be able to deploy capital through our services and create kind of like a marketplace component. I think we'll probably still be just continuing to raise internally and through a kind of a fund-like structure. But we do have some plans in the decentralized finance space for in the future. So it could very well likely happen. To answer your first question about the kind of the credit modeling and how that works for a company side, we're deploying capital into companies now that are more early stage technology companies that wouldn't really have access to traditional financing. And to confirm, like our credit model is going to look a lot different than what a Schedule 1 bank's small business credit model might look like. And certainly the companies that we're looking to fund would not qualify for that type of financing, mostly because they don't have the assets to collateralize against. And so it is a bit of a different kind of market than what the larger banks are investing in currently. But certainly as the digital economy continues to grow, I think these financial institutions are going to need to adjust their credit modeling and adjust how they approach funding small businesses. And that's where we are honing our credit modeling and honing our design of an instrument that is best suited for these types of companies that are fast growing. They generate the majority of their investments online, their revenue online, and don't have assets to collateralize against, or don't want to put up personal guarantees to access capital from more traditional sources.
That's great. I understand a little bit more. I guess it's when you use 750, you kind of threw me. So 750 is a number that's in your model. And maybe if you're using that, you might put a little bit of context around that, maybe compare it to what it is in a real model. But to me, 750 on a business side is a relatively high score because I'm thinking of more traditional models.
Right. So I mean, our technology product as well, obviously the credit model gets adjusted based on who the funder is and what they're looking for. But yeah, certainly for us in our product, that the 750 is just our base score for moving to the next step. And we did want to mirror it against more traditional credit models that are out there today. And so that's where the score out of 1,000 is generated. And certainly 750 is a good score. And the types of companies that we'd look to invest in.
Yeah. So are you trying to suggest that a 750 of your score is, more or less equivalent to like a 750 FICO score? Because that's actually, that's a decent cutoff. Yeah. I think it cuts two ways. I think it may actually just do yourself a disservice by having trying to model yourself against the FICO scores in terms of like leveling. because even the FICO scores are not particular. It's not a distribution. There's very few people have 0, and there's almost nobody that's 1,000. I mean, everyone kind of clusters in between 650 and 850. And so even in your own model, it was a much broader distribution than that. So anyway, it's something worth thinking about. It could be the right approach, maybe not. It's not super clear. I think I have a bigger pet peeve, which is, I'm a big believer in royalties and streaming and revenue sharing. These are all very useful financial products that exist, but comparing them, I'm not sure it actually really helps you to compare that against venture capital money, whether it comes in as a convertible product or as a preferred equity or even venture debt. They're just different financial products for that serve a different purpose altogether. And so, and actually, in some ways, I think that this is actually an opportunity that is actually not being attacked in the market, because there's a couple of other companies out there, I'm not going to name any names. This is your demo, that are offering very similar types of revenue streaming deals, revenue share opportunities out there. But I think there's an opportunity to say here, let's learn digitally about you, because I agree the fundamental thesis is that let's use data that exists out there, especially in the digital economy, to underwrite you a better product. It could be that the right product is a venture product, right? Exceptionally high growth business where every dollar spent on growing the business helps accelerate it, should not be in a revenue sharing deal. They should be raising venture money. Right, they should be going out for very expensive money because they can grow that much faster. Business that has more of organic growth, or has a cap on their growth, where they can't spend every dollar that they can to grow, absolutely should be in a revenue sharing deal. And they shouldn't, in no way should they be in a venture, and you should be taking venture money. And so, if you can digitally understand about these businesses, you could actually be in a position to direct them towards the right financing sources or financing products.
Sure, definitely. No, that's a great point. I think our thesis and the thinking that we want to promote is that there are alternative models out there now, and you can leverage a number of different products in order to execute on your vision from a capital stack standpoint. Certainly, I think the notion today is that let's just raise a large venture capital round without really understanding the costs associated. And I think that there are a number of things that you should be funding from a more non-dilutive standpoint rather than an equity raise. But definitely having a better understanding of what's available in the market, and certainly coming up with new instruments to be able to fuel even just a portion of that growth can certainly save founders in the long run. I think people kind of certainly first-time founders often overlook the value of giving up a large percentage of your company for what might be a kind of a nominal check size in the early stages.
I had just a last question, a little bit on the reporting of the financials. Maybe my question isn't so relevant because I thought it was I thought there was a two-way platform here where investors could participate in order to be able to fund these revenue streams. But how are they reporting back digitally? So are you plugged right into their sales system? I'm just trying to figure on that tracking system and keeping fraud out of it and keeping everybody honest.
Sure, yeah. So we've developed APIs through online banking, online accounting, and payment processor systems. And so similar to, anything from a kind of a QuickBooks Online to PayPal to your online banking. Our APIs connect for a one-way flow of that data. So we just have read-only access. That data gets refreshed on a monthly basis. Obviously, there are kind of different ways of accounting and things that founders do. And so certain aspects of the data coming in are still done personally by a founder, but the data that comes in from online banking and payment processors are ones that are actual from account. but we certainly do double check on the accounting side based on actual like account prepared documents that come through to ensure that there's no kind of even mistaken reported information that comes in. But and certainly it's quite easy to spot once you see the actual data that comes in if there are things that look like they are in the wrong areas. So.
We're being told to wrap it up here, but I do have one last comment. This is a demo, and so feedback would be, I would have loved to have seen us walk through as part of the presentation a demo of like the client onboarding experience, for example. Like, how do I apply? What connections do I need to make to my digital systems? I would have liked to have seen that. I think that would have improved the demo of the demo part of this, if you will. Yeah, no, it's a great point. It's unfortunately a lack of time more than anything. So the 7 minutes is a little restricting on the whole process. The onboarding process does take about kind of 10 to 15 minutes, and then that's just one section of the technology products that we offer. And so, but definitely in a demo with a little more time, you can definitely go through everything and see how the process works. Understood. Good job. Well done. Thank you very much.